If you're running a business or you're looking to start a career in finance, you may come across the phrase accounts payable. But what does accounts payable actually mean, and why is it important? Well, in a nutshell, accounts payable refers to money that a business owes to third parties, such as suppliers, banks, other businesses, and anybody else. Usually, the money is owed because the business purchased goods or services from third parties, but the business hasn't paid the third parties yet. So, although the goods and services have been provided, the suppliers won't receive the money until a later date. Let's say you work for an accounting firm. Because your firm uses a lot of stationery, you order stationery in bulk from an online stationery supplier. They deliver it to your premises, and you pay for it at a later date. After making one particular delivery, the supplier gives you a bill for $500 with payment terms of 30 days. This means they have given you 30 days to pay without incurring any penalties such as interest or fees. By doing this, you have purchased goods on account, and because you need to pay money to your supplier in future, you have effectively created an accounts payable item. So, when the bill is entered into your accounting firm's bookkeeping system, an accounts payable item is created for $500, and it will stay like that in the system until you pay your supplier. When you do pay the bill, the balance of the $500 accounts payable item will decrease to zero, and your cash at bank will decrease by $500. So, as you can see, when you buy goods or services on account, you create an accounts payable item, and when you make payment in full, the accounts payable item is reduced to nil in the system. Now, before we go, there are a few important things to note. Firstly, when you see accounts payable on a balance sheet, the number actually refers to the total of all the individual accounts payable items that currently exist in the business. In other words, it's the total of all the bills you have received from your suppliers that are currently unpaid. So, for your accounting firm, if there was $10,000 in accounts payable on the balance sheet, this could be made up of the $500 you owe to the stationery supplier, plus $9,500 worth of goods or services from other suppliers you haven't paid for yet. And lastly, it's also important to note that not all money owed to third parties goes into accounts payable. You see, accounts payable is a current liability, which means it only tracks money that is expected to be paid within the next 12 months. Any money that is expected to be paid at a later date will be tracked somewhere else on the balance sheet, such as in a long-term loan account. So that's it for this video. To learn more about accounts payable, check out our other videos on the accounts payable process, what accounts payable specialists do in their job, the difference between accounts receivable and accounts payable, and more. See you there.